And the broadcast is live. Phil, Tarrant, Tom Panos, Real Estate Exposed, winding up. Not yet for 2022. Second day of December, pinching and punch and all that sort of stuff. Tom Panos, you've been pinched and punched around the last couple of weeks. How you been, mate? You well?
I'm better now. I want to apologise, Phil. Last week I had to pull out. I had a procedure done, an op on the Wednesday night, and that Thursday was our normal day, and so we're heading in the right direction. And I've got to tell you, Phil, it's been listen. What are we now? 330 days into the year. I can pretty much tell you 300 out of 330 I've been unwell. I've had maybe a month where it was okay, but thankfully it's not serious. And I take things from it, Phil. I take and I want all our listeners and all our viewers that are watching live to take that there is actually a gift going through difficult times, whether it's health or something. And that gift is normally the ability to have a clearer perspective about how good one's life normally really is, but one that you take for granted. And you take for granted because it's quite normal to actually feel that you're entitled to all these things in life. And you actually think to yourself, they're mine. I'm entitled to them. But for many people, Phil, health, money, living in Australia, it's a privilege, right? We are so grateful in this country. I know that you're very, very proud to call yourself an Australian. And actually, I'm going to yell it out here. Every guy and every girl that follows Italy or Greece or any of those teams in the World Cup, if you're born here, you're following Australia. And you're going to wake up on Sunday morning at 6 o'clock and you're going to watch Australia play Argentina. Are you a soccer man?
No. I used to play for the Toongabbie Demons back there until I was about 8 years old, and I was the prodigy that would have made us all the way over to Europe playing soccer, mate, but not for me.
Blacktown, mate, for the record, I know a little bit about that football area in Blacktown, a very, very successful nurture area of some of the greatest players that have come out of Australia. The club is quite famous there. Blacktown, I think they call it Demons or Blacktown Spartans, they're called now. A very successful club, and off the top of my head, they did win the NPL grand final this year. So they're a very, very successful club.
Well, it's really funny, and one of the reasons why Australia bats out of its average when it comes to sport is because, whether it's soccer or football or swimming or any other sport, right? For a very, very small nation, Tom, we produce really, really good sports people. And I think it's because that's what you do when you're a kid in Australia. You're out there playing sport. Maybe less so now. It was when I was growing up in the 80s. There was nothing else to do other than play sports. So you ended up being good at most sports in some sort of capacity because that's all you did. Whether that exists today and whether or not our reign of supremacy in sport, considering the size of our population, continues, I don't know, mate. But how do we spin that into a property sense? Our property seems to be overvalued when it comes to most other parts of the world. And the big concern now is everyone's worried about their back pocket, and the wealth effect with property is inside of everyone's heads. I think most Australians feel a lot poorer today than what they did 6 months ago because the prices of their property has gone down. That's the nature of the beast, and that's the way it worked. Guess what? Here's a news flash. It will go up again. And how do I know that? It's not because I'm the smartest bloke in land. It's because I'm a student of history who looks back over time of how property performs, and property markets go up or down, but the trend line is north, and always has been, and it always largely will be in Australia, and that's the way it works. We've been debating it, Tom. We largely see eye to eye most of the time. Sometimes we have a different opinion, but there's been some information coming out just these last couple of days saying that we're at the bottom and we're on the way up. I want to get stuck into that today, Tom, but you've just put this graph up, and I know you like it. The last 9 corrections for us who don't really have very good eyesight, Tom, can you run us through this again just to remind our viewers of how this works?
I showed it the other day, and I only brought it up just now to because it's got context to what we're about to say. And that is that over the last 35 years, there have been around 9 true corrections that CoreLogic RP data has been able to pick. And you know, as you said before, Phil, corrections don't last forever. There comes a time, and that time does not appear to be more than 2 years. And the reason why this graph's very useful right now is that Louis Christopher, who's been across all the press so he released his report on Wednesday, and Wednesday and Thursday, Fin Review, The Australian, all the News Corp Fairfax publications, all covered his report, which is really interesting because he uses what's called situational analysis. He doesn't go out and just say, this is what I think is going to happen in the market. What he says is, if this happens, this is the result. If this event happens, this is the result. And he's come up with 4 scenarios. The 4 scenarios are that rates stop going up, that rates, not only do they stop going up, but they actually start coming down later on next year, that rates start going down, the Reserve Bank gets it wrong and works out, hey, we got a problem here, and then they put rates back up. And then last scenario, I think he talked about is that it's just inflation, they can't get a hold of it, and they just keep going with the rate rises. But he's pretty confident that he believes it's going to be situation 1 or situation 2, and that is that rates are going to come to an end going up, and he thinks that it's going to be around February, March, maybe April, and that we're going to see then probably Sydney and Melbourne would have been 1.5 years into a price correction, and that would mean that the second half of the calendar year, June onwards, we're probably going to see a market that starts moving up. And his predictions are Sydney to go up between 5 and 10% or thereabouts. Melbourne close to that as well. So Phil, there's a lot of press about this. And I don't know. I mean, we wait to see, but I can pretty much tell you all the data that's coming out from auction houses at the moment are suggesting, in Sydney at least, we've had the best clearance rates for most of this year in the last month. So Phil, it's not all bad. It's not all bad at the moment. Has the market bottomed? We don't know. But what we both know, being real estate investors and supporters of that asset class, is that you're probably buying at a 15% discount. If it goes down another 5 or 10%, you're still doing a lot better than if you'd bought earlier on this year. But that's the scenario, Phil. And you were very accurate this year. I've got to tell you, you actually said we might not have a spring, but what has actually happened is spring seems to have been condensed into December. December is a jam-packed auction month.
Yeah. It's, to be fair, Tom, we've been doing this now for well over 2 years, Real Estate Exposed, and I reckon if you put us against most people in picking trends and the direction of property markets, I reckon we've got a lot more right than wrong. And maybe we should do a recap. If one of us was actually interested enough to go and look back through all these live streams we've done and pull out all the different trends that we've called, you can do that if you want, mate. Maybe, I don't know what you got time on your hands over Christmas when you're driving around, but I reckon we got more right than wrong. I expected the back end of this year to look like this. Now, the big thing for me, Tom, and it's interesting to see Louis' scenarios there, those 4 different scenarios. I subscribe probably to those first 2. There will be a variation thereof of that. My personal view, and I've thrown this idea around with other people in property, is that I reckon Australians are hurting a lot more than what they're indicating right now with the those with mortgages, with this interest rate cycle that we're in right now. I don't think the data has flowed through yet about how much spending is actually being or starting to be curbed as we come into the Chrissy period, and when retail spending should be strong and people should be out and about spending dollars. I reckon there's going to be a lot less people out there. So when those credit card numbers come in, I'll be really interested to see that, or consumer spending. I reckon consumer sentiment is the big one to watch, and this is what's inside of people's ears around their just their immediate attitude towards whether or not they've got money to spend, where they've got disposable income to splash around spending. I think as we move into whether people are going, I'll wait till Christmas, and then as soon as Christmas happens, I'll tighten the belt, and that's when I'll start really thinking about keeping an eye on the family books. And I think most Australians and Australian families can be forgiven for doing that because family balance sheets are so strong post-COVID with all the savings there. But those savings are starting to be eroded now. So I think most Australians will start going to an austerity mode come the new year. And for that inflection point to align with what Louis is saying there, with interest rates to stop going north as of March and April, I think what will happen is that there'll be a new baseline when Australian investors, Australian homeowners know rates aren't going up anymore. It does a strange thing to their head. They start thinking very differently about the market, Tom. They start thinking the market is good again rather than bad again. And if that aligns with an inflection point of rising prices, and you mentioned those numbers in Sydney and Melbourne, I think you'll get again a surge in prices towards the back end of 23 and into 2024. So that's my read at the moment, mate. Whether or not we'll get that one right or wrong, I don't know, but I'm subscribing to it, and I'm sort of acting on that sentiment myself.
Yeah, well, I think tomorrow, I'll be very surprised if tomorrow's auctions don't have buyers that have come out of the woodwork because of the press articles this week about it being close to the bottom. Actually, some have said it has bottomed in Sydney. So I'll be very surprised and feel sentiment and mood. It's a qualitative characteristic. But man, you can feel it. It's like the wind. Like you see, the cars are parked in the whole street. There's lots of people coming through opens. And I've always said it, Phil, when the market turns, it turns in the blink of an eye. It turns faster than what you realized, right? On your earlier point, I was in the city yesterday having a bite to eat with CoreLogic, and I then got a haircut, and then I was in the city, and I was thinking to myself, I might stay here because friends of mine had invited me to their Christmas party, and then I thought to myself, oh man, it's going to get crazy and hectic here. But Phil, it didn't get hectic. This is the Thursday night leading up, like just picture, this is the Thursday night leading up to Christmas when you're about to go into December. It should have Christmas parties, and on a Thursday night, you should have Christmas shopping. But it was very quiet, Phil. And I'm sure that what you're sort of saying, and that is disposable income and the mood of people spending money has probably changed. It should have been chock-a-blocker on a Thursday. It was a nice day too. Sun was out, you know?
Yeah, the sun was out. I was out for a lunch yesterday and down at Woolloomooloo, and I must admit there was people around, but it wasn't booming by any means. And that should have been a prime time for people to be spending bucks. And a lot of that is business confidence as well. I think a lot of businesses are tight on their purse strings at the moment. Because of the sort of this uncertain sentiment towards what 2023 is going to look like, and whether people don't want to come into Christmas parties anymore, Tom. I think most people are still holed up working from home. There is a spike in COVID cases. The health bodies are pretty much saying, you know, if you can work from home to try and get on top of it running up to the Christmas season. I think most people, you know, are fair weather COVID people these days. If it suits them to stay at home, they'll go, yes, I'm going to stay at home because that's what the health people are saying. But if they want to go out and have a bite to eat and a few drinks, they'll still get out there, mate. And there's a fair few people in the pubs. But, you know, the point is that are we at the bottom of this market? You're not going to know until we're some way post and we can actually go back in time and say, okay, that was the bottom. Some bright people will spot that and act on it. But to be fair, if you're investing in property, if you 3-4 months at the bottom, either side, right or wrong, it doesn't matter. It's largely irrelevant over time. It's a long-term investment. But, you know, I think the real impact of inflation and the real impact of mortgage rates, it's behind closed doors at the moment. People are starting to think about this has got to start, and it is start changing the way in which I'm spending my money. You're just not seeing it yet. You're not seeing it in the but you're not seeing it in the numbers. And much like the property market, Tom, these things turn really, really quickly. There'll be a couple of flashpoints. There will be a catalyst for each individual, whatever that is, where they just go, I've got to start doing something about this. So it's probably happening at home in quiet. People are saying, we've got to stop doing this stuff. Maybe we can't go away as a family for this Christmas. Maybe we can only go for 1 week rather than 2 weeks on our family holiday. Those decisions are being made. They're just not coming out in the numbers. So wait for early January 2023, and I think you'll see the brakes put on for a lot of people. A lot of people just tap them just to slow down a little bit, make sure they keep things aligned and in tune. But I think for a lot of people, if there is 2 to 3 more rate rises coming, who knows what's going to happen on Tuesday of next week. I think we spoke about this the last time we got together, is when the Reserve Bank is going to meet. 25 basis points, good chance. I don't know, Tom, do you still sit there on 25 basis points for for the December RBA?
Yeah, I'm with you. I think a 0.25% in December. I think January, well, they don't meet. February, depending on how things are going, maybe again a 0.25%. There's this constant feeling, and the press and the economists with the banks are all sort of saying it's probably going to land. It's probably going to land at roughly around 4% cash rate. Whether they do that in 0.25%, whether they do 1.5%, that's where they're saying it's going to land. But it's interesting as well, Phil, that even last week, the Reserve Bank governor said he wanted to apologise if any people made a decision to buy real estate or buy at a higher price based on his comments. But it was a straight out apology. It was a sorry, and I think that they understand that there's a bit of damage control that they've got to do with their brand there. And as Harmison says, Reserve Bank says a lot of things, people have lost faith in what they say anymore. One more unexpected move from Feds will follow. Yeah, look, there's probably an element, Phil, there's probably an element of truth that, you know, if the Reserve Bank says something now, you might half believe it more. That's the way life is. And then we've got Rebecca. People are buying cheaper online than rather in shops, and that's probably been accentuated during COVID. Phil, you know, like I did a presentation to Sutton. I did a presentation to Sutton's, their big truck division. Average price $250,000. So there's 10, 15 salespeople, great guys there at Sutton's in Olympic Park. And
what's a real estate guy doing talking about selling trucks, mate?
I just changed the words from house to trucks. That's all we do, Phil. It's actually not much different, but there was one big difference. If you want to go buy a truck and you put a deposit on today, you're not getting it earlier than 2 years, right? You're not getting it earlier than 2 years. So it's not 1.5 years, 2 years. And the reason why is that this online products need to be moved around. They need to be moved around. And this has been accentuated during COVID. So Rebecca's probably right. And then Harry's come on and said, no one can pick the bottom or the top. The time to buy is when it's right for you and you only. Yeah, we sort of subscribe to that to that theory. But Phil, the other thing that I couldn't get over, I read this morning, and I remember when we ran around doing the Better Business conferences a few years ago, it was 45% of loans were done by mortgage brokers. It had gone up dramatically. Now the number is 71%. I mean, this model has totally shifted. Does that number sound right to you? This is a number that was in the Fin Review.
Yeah, mate, it moves a couple of percent sort of around there. I had in my brain sort of high 60s. I don't know. The numbers probably come out of one of the industry bodies. I haven't read the report, but yeah, Tom, that's new loans or refinances? Didn't go into details. You don't know. New loans?
No, it didn't go into details. It just says 71% of loans are now done by mortgage brokers and banks.
Mate, it's a lot. I remember when I started knocking around mortgages as a journalist 19, 20 years ago. I'm starting to show my age there. It was one of my first jobs. It was 16%. 16% of of mortgages were originated by mortgage brokers. Now it's the majority. And I think you could say the majority of home loans now are originated by a mortgage broker. It just goes to show, despite some of the headwinds mortgage brokers have had over many years, including, the implementation of a lot of compliance and regulation and sort of best practice type ideas, notwithstanding, the initial Royal Commission findings, which were unwound and never implemented, which was pretty much saying cut mortgage broker commissions. The mortgage broking sector is surging, Tom. The reason why, it gives Australian borrowers better choice than going directly to the bank. Good luck, by the way, walking into a bank branch these days. They're closing like you wouldn't believe. So for many people, the only way to access a mortgage now is through a mortgage broker. And guess what? You're probably going to be able to find a better product for you, because they're going to be able to showcase hundreds, thousands of different products rather than a handful that a bank manager is going to be able to give you. So, yeah, of course, mortgage broker market share is going to grow. We have the advisor, the advisor.com.au. Tom, I know we have a lot of mortgage brokers tuning into this. I know we know a lot of the same mortgage brokers. They mortgage broking is hard. It's hard work. And what brokers do for consumers is often overlooked and sometimes really not acknowledged. So it's good to see mortgage brokers kicking goals. I think the financial system is better off for having mortgage brokers inside of it. It provides consumers choice. That's a key thing, Tom. And I remember when the Royal Commission handed down those findings, we were pretty active and vocal in trying to give sense and guidance around it. And we went out and we did a massive research report of Australian consumers. It was a report that made its way all the way through the halls of power in all the different state and federal governments. It was part of the mechanism for them to rethink how they were going to implement any of these changes. And it pretty much said 96, I can't remember exactly, it was 96 of Australians were happy with the service they got from mortgage broker. They preferred it. And asked the big question saying, if you had to pay for that service, would you still use a mortgage broker? And as a fraction of people would have done it. So if they actually changed the remuneration structure for mortgage brokers, it would have decimated the mortgage broking industry without doubt, which would have meant less choice for Australian consumers, which means they probably would have ended up paying more money on their mortgages. So good on mortgage brokers.
Well said. Well said. Phil, my recommendation to all our viewers and listeners that the consumers are not in trade, I'd have the deadline by June 30, you got to buy a property. You got to buy a property because I think after that, you're putting yourself in an unnecessary position of having to worry about racing and buying something quickly because the market starts moving, right? I think you've got time. I think December's a great, like Phil, December's a great time to buy a home, by the way. The last week of December, when people have got a few hangovers or they're at the beach, they're not at an open home, you got a desperate vendor that wants to sell their place. They want to bring closure. They want to go on their break bringing closure. You got a chance of getting an offer that's lower to get accepted. That's what you want to be doing. You want to be at an open on the 10th and the 17th of December. But Phil, we're going to look back on this in 6 months, a year's time. I'm going to actually say that I believe Sydney and Melbourne is at the bottom or close to it. Queensland, not quite yet. Hobart, not quite yet. Adelaide still got a little bit to go. Perth, I actually think, may actually come out of this being resilient because it's had 15 years of hardly anything happening for it. And, I think, Phil, what's your view? I mean, do you want to say something on that?
I'm not in the business of predictions, but one thing I would say, Tom, and you had a comment there in relation to the dissolution of trust in the Reserve Bank of Australia. So the point being that a lot of Australians made property buying decisions on this indication from the Reserve Bank that they wouldn't push rates up to 2024. Like that should be not how you're making buying and investing decisions in real estate. If you're an occupier or a property investor, you buy real estate on the basis of whether or not you could afford to buy real estate. You need to understand what the worst case scenario is before you buy any property. you should be taking responsibility for factoring big buffers into your own capability to service a mortgage. That's not anyone else's responsibilities. That the banks have metrics and mechanisms to police that. It's called serviceability. What most Australians do, Tom, is they go to the furthest end of their serviceability at the point of time of securing a mortgage. Now, guess what happens when rate goes up? That means you're way out of kilter. So you've got to be conservative in this sort of stuff, and you can't outsource that responsibility. So when I hear people talking about, oh, I've been let down by the Reserve Bank of Australia, it's not fair, I made this decision based on what it is right then, I didn't know this was going to happen. You've got to take you can't think that way. You've got to actually police and patrol your own backyard, and that's my point on that. Whether or not we are at the bottom at the moment, and how markets will perform in 2023. I reckon some markets have already bottomed or never bottomed. Some markets have continued to go north, and we shouldn't be consumed by this idea that real estate in Australia is what happens in the Sydney and Melbourne metropolitan areas. Australia is a big place. I've been out there. I've had a look at it, as have you, Tom. Some markets have continued to perform despite this universal softening of property prices. So you can't look through the lens of Australian property by those two markets. So some places have never bottomed. Some places potentially softened for a small period of time, and those basic inherent fundamentals have driven growth ongoing. That has happened and will continue to happen. So the big question is around what happens in Sydney and Melbourne and the sort of surrounding areas. We're not far off it. Whether it bottoms this year or early next year, again, it's largely irrelevant. I subscribe to your idea. You've got this 6-month time horizon to get your stuff in order. Go and see a mortgage broker. They're busy. I'll tell you that based on those numbers you shared with us, Tom. But get yourself sorted. Get your finances ready. Get your tax returns done. Be finance ready. Have a pre-approval. So when you're ready to buy and you're confident about your ability to service a mortgage, even if it's 1% to 2% more than what it is today, go out there with confidence and secure property in that window of up to June, July of next year would be what I would be doing, and it is what I am doing, Tom, and I think you are also doing that yourself.
Yeah, 100%. That's 100% I am. I'm on realestate.com and Domain pretty much every day at the moment. I'm following it. I find it extremely useful. To see what I particularly I like looking at the just sold section. The sold section gives you a lot of information. It tells you in the date and the price that it's sold for, and that data is extremely useful. Phil, Tarrant, we're gonna run through right to the end of this. We'll go right up till Christmas time with our live stream. Thank you so much, an absolute pleasure. And I might text you on Saturday afternoon and let you know what those results are like. I'm very fascinated. I got a big day. I think there's 14 on, so it's a good sample size.
What's your prediction, Tom? Give us a prediction. Percentage sold.
8 out of 14. 8 out of 14.
Out of 14.
So
you reckon about 60%?
Yeah, but then two will get sold on Monday, so that'll be like 10 out of 14. Maybe 1 or 2 will get sold that week, and 2 probably won't sell. So that's what I think will happen. All righty, sir. Thanks so much. Thank you. Have a great week, everyone.
You too.